Making tax digital for income tax started on the 6th of April 2026 for sole traders and landlords with income over £50,000. But for limited companies doing R&D work, MTD raises a specific question. Does digitalizing your records change how you document and file your R&D claim? The answer is yes, in one specific way, and that one specific way is the compliance risk that most directors doing R&D work are not aware of yet. By the end of this video, you will understand what making tax digital actually means for your R&D claim. You will know why MTD does not directly apply to limited companies, but why it still matters for your R&D documentation. And you will know exactly what HMRC now expects to see when they review a claim, and what you should change if your current process does not meet that standard. This is the clearest explanation of the MTD and R&D crossover that you will find. This video features an AI-generated presenter. All content is for educational purposes only and does not constitute tax or financial advice. Always consult a regulated specialist for your specific circumstances. Here is the context. Making tax digital for income tax self-assessment, known as MTD for ITSA, is a significant change to how sole traders and landlords keep records and report income to HMRC. From 6th April 2026, those with qualifying income over £50,000 must use MTD-compatible software and submit quarterly updates digitally. HMRC has confirmed this phased rollout in their Making Tax Digital for Income Tax guidance published at gov.uk. Now, here is the misconception that is circulating right now. Many directors of limited companies heard about MTD starting in April 2026 and assumed it applied to them. It does not yet. Limited companies are not in scope for MTD for ITSA. If your company is a limited company, you are still filing corporation tax returns through the standard process. But here is where the conversation gets more important for R&D claimants. MTD for ITSA is built on one foundational principle: contemporaneous digital records, and that same principle has been hardening across everything HMRC does, including how it evaluates R&D tax credit claims. The honest question is not whether MTD applies to your company. The honest question is whether your R&D documentation would survive the level of scrutiny that MTD has now normalized across HMRC as a whole. Here is the specific thing that changes. HMRC's R&D tax relief guidance, available at gov.uk, requires that R&D claims are supported by contemporaneous records. That word, contemporaneous, means records created at the time the work was done, not written after the fact at year-end. For years, many companies have treated R&D documentation as an annual exercise. A finance director or founder would sit down in January, recall the projects worked on in the previous financial year, and write up project descriptions retrospectively. That approach has always been a compliance risk. But MTD has hardened HMRC's expectations across all record keeping, and their compliance teams are now applying the same contemporaneous standard to R&D documentation that they apply to accounting records under MTD. HMRC R&D tax credit statistics show that the number of compliance checks on R&D claims has increased significantly since 2022. The introduction of the additional information form in August 2023 was part of the same shift, a structural requirement for more detailed project-level documentation submitted before the corporation tax return. MTD did not create this expectation, but it has accelerated it. The direction of travel is unambiguous. HMRC expects records that were created when the work happened, not when someone remembered to write them up. So what does good R&D documentation look like under the current expectation? 3 things. First, dated project records. Each qualifying R&D project should have a record created during the period the work was happening. This does not need to be a formal document. A dated internal note, a technical specification, a ticket in your project management system, an email thread describing the problem and the approach. Any of these works. What does not work is a single document written in December describing 12 months of technical activity with no contemporaneous trail. Second, structured uncertainty records. HMRC's qualifying test for R&D is whether there was genuine scientific or technological uncertainty that a competent professional could not resolve without investigation. Your records need to capture what that uncertainty was, when you identified it, and what you did to try to resolve it. A vague statement written at year-end that your team was working on something innovative is not the same as a dated technical note from the time that explains the specific problem. Third, cost allocation records. Staff time, subcontractor costs, and consumables that qualify for R&D relief need to be traceable to the projects that generated them. Payroll records alone are not sufficient if they cannot be tied to qualifying project activity. Digitized, structured cost records, the kind of records that MTD-compatible software produces as a matter of course, are what HMRC expects. Here is the risk that makes this urgent. R&D claims must be filed within 2 years of the end of the accounting period they relate to. If your accounting year ended 31st March 2025, your deadline to claim for that year is 31st March 2027. That window sounds comfortable, but if the documentation for that year is thin, if it was written retrospectively and lacks the contemporaneous detail HMRC now expects, you have a problem that cannot be fixed after the fact. You cannot go back and create dated records for work that happened in 2024. The records either exist or they do not. This is why the MTD conversation matters for limited companies right now, even though MTD for ITSA does not apply to them. The shift in HMRC's approach to record keeping is not isolated to income tax. It is a signal about how HMRC views compliance across the board. Companies that treat the next 12 months as an opportunity to put a proper documentation process in place, dated, structured, digital, contemporaneous, will be in a significantly stronger position when they file their next claim. Companies that wait will find that the records they need simply do not exist. So to bring this together, Making Tax Digital for Income Tax started on the 6th of April 2026. It applies to sole traders and landlords, not to limited companies. But MTD has hardened HMRC's expectations around contemporaneous digital record keeping across all compliance areas, including R&D. If your company has been writing R&D project descriptions retrospectively at year-end, that is now a compliance risk. The fix is straightforward. Start keeping dated, structured project records now, and check whether your current documentation would support a claim if HMRC asked to see it today. If you are not certain whether your current R&D documentation meets HMRC's current standard, the practical next step is a free assessment. The assessment covers whether your company qualifies for R&D tax credits and whether your existing records are sufficient to support a compliant claim. If there is a claim, you will be introduced to a regulated specialist on a no-win, no-fee basis. If there is not, there is nothing to pay and you will know where you stand. The link is in the description below. The address is uplifttax.com/partners/M7X2K9. It is also pinned in the comments. Making Tax Digital has changed how HMRC thinks about records. The companies that adapt their R&D documentation now will have stronger claims, fewer compliance checks, and less risk over the next 2 to 3 years. The ones that do not will find out at the worst possible time. If you found this useful, the video on what HMRC actually looks for in an R&D compliance check gives you the detail on how to build documentation that holds up. It is on screen now. I will see you in the next one.